Usually when we talk about like a medical diagnosis, there's this expectation of total precision.
Right, like an engineering schematic.
Exactly. You break your arm, the X-ray shows that jagged white line, and the doctor just points at it, says, there it is.
Broken or not broken. It's clean.
Yeah, it's visible. But step into the world of professional wealth management, and that X-ray machine is just totally broken.
Oh, completely.
We're looking at a financial landscape that is incredibly murky. I mean, it's built on human emotions just as much as it is on strict mathematics.
It really is the absolute definition of diagnostic muddy waters, because a professional isn't just diagnosing a market.
Yeah.
They are diagnosing a person.
Yeah. And today, we're using Chapter 9 of the NISM certification workbook for portfolio management services distributors to build the exact blueprint managers use to do that diagnosing.
It's a fascinating document.
It is. We are looking under the hood of the portfolio management process to see how top-tier managers actually make decisions, structure investments, and, protect wealth. Because managing wealth isn't just picking a winning stock. Okay, let's unpack this.
Yeah.
Because it's a rigorous, multi-step, psychological and mathematical gauntlet.
Yeah, and whether you are managing your own savings right now or you are looking to hire a professional, understanding this exact framework is what moves you from gambling to actual calculated investing.
I love that distinction.
That distinction is the bedrock of this entire text. Gambling is an event, right? Investing is a process. The NISM text doesn't offer a series of hot stock tips.
No, not at all.
It lays out a deeply logical architectural sequence. It explains the underlying why behind every single rupee, dollar, or euro deployed into the market.
It provides a structural blueprint that kind of shields you from your own worst instincts.
Exactly.
Well, I want to start right there with that blueprint, because the process doesn't actually begin with the stock market at all.
No, it doesn't.
It begins with you, the investor, by creating what the source calls the investment policy statement, or the IPS.
The IPS is it's the foundational document of the entire relationship between an investor and a portfolio manager.
Like a financial GPS.
That's a great way to put it. I mean, before a single share of stock is purchased, this document has to clearly outline the investor's objectives, their constraints, their unique preferences, and, critically, their true tolerance for risk.
Here is my immediate pushback on that, though.
Okay, let's hear it.
I see this all the time. People are notoriously terrible at knowing their own risk tolerance.
Like, universally terrible.
Right. Like if you ask someone, are you a risk taker? Everyone says yes when the market is booming.
And everyone says no the minute it crashes.
Exactly. So how does a portfolio manager actually figure this out objectively, rather than just taking a client's, highly biased word for it?
So the NISM text addresses this behavioral flaw beautifully through the mechanics of risk profiling. It relies on a structured mathematical and psychological assessment.
Okay.
And the text highlights a crucial, often completely misunderstood difference, the difference between risk tolerance and risk capacity.
See, to me, those just sound like synonyms. What is the actual difference?
Well, risk tolerance is purely psychological. It is your emotional willingness to take a risk.
Like how much sleep you'll lose.
Exactly. It's how much sleep you will lose if your portfolio drops, say, 20% in a single month.
Right.
But risk capacity is entirely financial and mathematical. It is your actual ability to take a financial hit without it destroying your standard of living.
Or derailing your critical life goals.
Exactly.
So imagine you, yes, the person listening right now,
Yeah.
have a massive risk tolerance. I mean, you love skydiving, you love crypto, you're doing angel investing.
You're an adrenaline junkie.
Right. But you just lost your job, your industry is facing massive layoffs, and you have a new baby and a mortgage to pay.
That changes things.
Your psychological tolerance is sky high, but your mathematical capacity is basically zero.
And a good portfolio manager has to spot that discrepancy immediately. The reverse scenario is just as common, by the way. Think of a 70-year-old multimillionaire with a guaranteed inflation-adjusted government pension.
Oh, wow. Yeah.
Their risk capacity is enormous. I mean, they could lose half their portfolio and their daily life wouldn't change at all.
They're still eating steak every night.
Right. But psychologically, they might be terrified of losing a single penny, so their risk tolerance is extremely low.
So which one wins? Like if I have high capacity but low tolerance, or vice versa, how does the manager actually build the IPS?
Well, the manager generally has to build the portfolio to respect the lower of the two metrics.
Oh, really? The lower one?
Yeah. If you have the capacity but not the tolerance, putting you in an aggressive portfolio will just cause you to panic and sell at the worst possible moment.
Because you'll get scared.
Exactly.
Yeah.
Now, if you have the tolerance but not the capacity, putting you in an aggressive portfolio is basically financial malpractice.
Because they could lose money, they actually need to survive.
Right. And the NISM material actually gives us the specific questionnaire metrics used to calculate all of this objectively.
Let's dig into those metrics because it's fascinating to see what they actually measure on paper.
Yeah, it's very detailed.
They look at age, naturally,
Sure.
but they also look at primary financial goals, comfort with short-term losses, the percentage of your current investments that are already in equities.
And a huge one-income stability.
Let's run a hypothetical scenario using their exact scoring system.
Okay, perfect. The questionnaire asks if your income is highly stable, moderately stable, somewhat unstable, or unstable.
And they assign weights to these answers.
Right. A highly stable income, say a tenured professor, gets a score of 5. An unstable income, like a freelance consultant in a cyclical industry, gets a 2.
Because if your income is a guaranteed salary, your capacity to take risks in the market is just much higher.
You don't need to raid your investment portfolio just to pay your electric bill on a slow month.
Right, that makes total sense.
They do this across all the metrics. Let's look at investment horizon. If your goal is more than 10 years away, you score a 5.
Okay.
If it's below 3 years, you score a 2.
Why is that?
Because the stock market is highly volatile in the short term, but historically trends upward over the long term.
So you need time to recover.
Exactly. If you need the money in 18 months, you have no capacity to wait out a sudden bear market. At the end of the questionnaire, they tally up the score.
And that score literally dictates your financial identity. The text outlines 4 categories based on the total score, right? Risk-averse, conservative, moderate, and aggressive.
Yeah, those 4.
And this isn't just a fun online personality quiz. That score translates directly into a hard strategy.
It really does.
If you score risk-averse, which the text says is a total score below 13 on their scale, the investment strategy must be capital preservation-focused investments.
That means lots of safe debt instruments, government bonds, and very little equity.
But the text also implies a very dynamic reality, right? Like an investor's risk profile isn't carved in stone.
No, it is highly fluid. Let's say you take this test today. You score as aggressive because you're 35, you have a highly stable income, and a 20-year horizon.
Okay, so I'm heavily invested in equities.
Right. But then an unforeseen event happens next year. You face a sudden, severe medical crisis that forces you to stop working.
Oh, wow. So my income stability just went from a 5 to a 2 overnight.
Which means your total score plummets. You are no longer an aggressive investor.
Right.
The fundamental reality of your life has changed, which means the IPS has to be fundamentally rewritten.
The manager has to actually intervene.
Yes, the portfolio manager has to immediately adjust the portfolio to match this new lower risk capacity, usually by shifting assets from volatile stocks into stable income-generating bonds.
Okay, so we figure out the risk, the terrain. We are mathematically and emotionally capable of driving on.
Yeah.
Now we need to know the destination, the goals. But you can't just walk into a wealth manager's office and say, I want to be rich.
I mean, you can, but it won't help them.
Right. You have to define what the money is actually doing.
This is where we move into defining the objectives. The text categorizes 5 specific investment objectives.
Okay, let's go through them.
First is capital appreciation, which is growing the absolute value of your wealth over time.
Making the pile bigger.
Exactly. Then there's income generation, which is producing regular cash flow like dividends or interest payments.
Like a paycheck from your portfolio.
Right. Third is capital preservation, which is simply fighting inflation and not losing the principal amount you started with.
Keeping the pile safe.
Fourth is liquidity, ensuring you can convert the investments to cash quickly without a massive loss in value.
Okay.
And finally, tax efficiency, which is optimizing returns after the government takes its cut.
You know, I look at that list and my instinct is just to tell the manager, I want all of them.
Oh, everybody does.
Right. I want maximum growth, high monthly income, 0 risk of losing my money, and I want to be able to withdraw it tomorrow with absolutely no taxes.
And that is the exact moment the portfolio manager tells you that you are living in a fantasy world. Because these objectives are inherently in conflict. You cannot have maximum capital appreciation and maximum capital preservation.
Because growth requires risk.
Exactly. To grow wealth significantly, you must take on the risk of losing it. You cannot have high income generation and high tax efficiency because income generated by dividends and interest is heavily taxed in almost every jurisdiction.
So the IPS forces you to prioritize.
It does. It forces hard choices.
And that prioritization naturally introduces the constraints. Now, here's where it gets really interesting to me. I think most people view constraints as a negative.
Like a roadblock.
Yeah, a limitation holding them back from making maximum money. But based on the NISM framework, constraints are actually the guardrails that make a portfolio customized to your specific life.
That's spot on. The text outlines 5 strict constraints: liquidity needs, regulatory or legal constraints, tax constraints, exposure limits, and unique needs.
Okay.
You cannot optimize a portfolio without respecting these invisible boundaries. Let's look at the goal sheet concept they use.
Yeah, I wanted to talk about that.
It asks investors to list their goals, the priority of that goal, the time period, and the amount needed.
The text notes that near-term, high-priority goals are highly emotional. Things like your child's education fund in 2 years, or the exact down payment for a house you're under contract to buy next year.
Because they are highly emotional and in near term, they act as a massive constraint on the portfolio.
How so?
The cost of not achieving these specific goals is simply too catastrophic to risk. Therefore, the funds earmarked for these goals must be placed in safe, cash equivalent, or short-term fixed income assets.
So you can't be aggressive with that money.
Absolutely not. You cannot put your kids' college tuition into volatile tech stocks if tuition is due in 18 months, even if you think tech is going to have a great year.
Because if tech crashes, your kid doesn't go to college.
Right. That is a hard time constraint directly overriding the desire for capital appreciation.
Okay, what about regulatory and legal constraints? A retail investor might not think about those very often.
They are critical in institutional or specialized wealth management. If you are managing money for a trust set up for a minor, there are strict legal guidelines governing what that trust is allowed to invest in.
Right, the law steps in.
Yeah. A portfolio manager might see an amazing generational opportunity in a high-risk venture capital fund, but if the trust's legal charter explicitly forbids alternative or illiquid investments, their hands are tied.
They cannot legally make that trade.
Exactly.
The constraint that I found most fascinating, though, was the unique needs category. This is where human psychology and personal ethics throw a massive wrench into the mathematical models.
Oh, definitely.
The text gives examples of socially responsible investing, an investor who absolutely refuses to buy stocks in tobacco companies or weapons manufacturers or, companies with poor environmental records.
ESG constraints, environmental, social, and governance.
Right. But there is another unique constraint that happens all the time. An investor holding on to a massive block of stock in their own employer, purely out of emotional attachment or a misplaced sense of loyalty.
It is a classic behavioral bias.
But wait, let me play devil's advocate here.
Sure.
If I work at a massive tech company for 10 years, I know the product inside and out. I know the CEO's vision. I know the sales pipeline is strong. Isn't that a legitimate information advantage?
People think that, yes.
So why shouldn't I hold 50% of my net worth in that stock if I genuinely believe in the company?
Because of a concept called idiosyncratic risk and the dangerous compounding of human capital and financial capital.
Okay, break that down for me.
Think about companies like Enron or Lehman Brothers.
Oh, wow. Yeah.
The employees working there thought they knew the company inside and out, too. If you have half your net worth in your employer's stock, you are entirely undiversified.
All your eggs are in one very specific basket.
Exactly. If the company faces a sudden catastrophic scandal or a massive sector downturn, the stock plummets. Your financial capital is destroyed.
Right.
But simultaneously, because the company is failing, they do mass layoffs. You lose your job and your salary, your human capital.
Right.
You lose your bonus. You lose your life savings and your ability to earn an income on the exact same day from the exact same event.
That is terrifying when you frame it like that.
From a purely mathematical portfolio management perspective, it is a disaster waiting to happen.
So what does the manager do?
The portfolio manager's job is to systematically convince the client to sell down that emotional attachment and diversify despite the client's resistance.
But what if they just won't?
If the client is absolutely stubborn and refuses, it becomes a hard constraint in the IPS.
Wow.
The manager must then build the rest of the portfolio around that massive localized risk, usually by buying ultra-safe assets to counterbalance it.
Okay, so we have our GPS programmed, we have our IPS, we know our risk capacity, we had defined our objectives and mapped our constraints. What is the next step in the process? Because we still haven't bought anything.
No, not yet. Step 2 involves forecasting and, most importantly, benchmarking.
Benchmarking.
First, the manager looks at capital market forecasts to establish expected opportunities based on historical risk-return data across different asset classes. But the cornerstone of evaluating if your strategy is actually working over time is establishing a benchmark in the IPS.
A benchmark is just a point of reference to evaluate performance, right?
Yeah.
Like if your portfolio returns 10% in a year, you have to ask, is that good or bad?
And you can only answer that relative to a benchmark.
Right.
If the overall market went up 20% that year, your 10% return is actually terrible. You underperformed.
But if the market crashed?
Exactly. If the market crashed and went down 5%, your 10% positive return makes you an absolute genius.
But the text is very clear that benchmarking is about the apples-to-apples comparison. You can't compare a conservative government bond portfolio designed for capital preservation to a highly aggressive tech-heavy stock index.
No, it's an invalid comparison that tells you absolutely nothing about the manager's actual skill.
It's like making a boxer weigh in. You can't put a 130-pound lightweight in the ring with a 220-pound heavyweight champion and expect a fair fight. You have to declare your weight class, which is your specific investment strategy,
Right.
and you have to fight the appropriate opponent in that same weight class, which is your benchmark.
That is exactly how it works. And the NISM text lays out some incredibly strict formalized rules about this from the Association of Portfolio Managers of India, or APMI.
Tell me about those rules.
The regulatory oversight detailed here is designed entirely to protect the investor from deceptive marketing.
Okay.
According to the APMI rules, a portfolio manager must tag every investment approach they offer to a specific broad strategy. The core-defined strategies are equity, debt, hybrid, and multi-asset.
So they are legally forced to declare their weight class.
Exactly. And APMI prescribes a maximum of 3 benchmarks for each of those core strategies.
Oh, so they give them a menu.
Yes. When a portfolio manager tags their approach to a strategy, they must select one of those regulator-prescribed benchmarks. They cannot cherry-pick some obscure, terrible-performing index just to make their own returns look artificially superior.
There is a specific rule in the text regarding this that I think is a massive win for the consumer. It involves something called an exit load.
Yes.
First, what exactly is an exit load in this context?
An exit load is a fee or a penalty that an investor is charged if they withdraw their money from a fund or a portfolio management service before a specified period of time has passed.
Kind of like an early termination fee.
Right. It's designed to discourage investors from constantly pulling their money in and out, which creates liquidity problems for the manager.
Got it. So the text states that if a portfolio manager decides they want to change the underlying strategy or change the benchmark for a specific investment approach, they must offer the investor an option to exit the strategy entirely without paying any exit load.
Yes, that is a huge rule.
Why is that rule so important?
Because it prevents the portfolio manager from moving the goalposts mid-game to hide bad performance.
Oh, wow.
Imagine a manager who launches an aggressive equity fund and promises to beat the Nifty 50 or the S&P 500. Investors flock to them and pay the fees.
Because they want those big returns.
Exactly.
Right.
But after 2 years, the manager is failing miserably. They are lagging way behind the benchmark.
Okay.
Without this regulation, the manager might quietly change their benchmark in the prospectus to a much easier, lower-performing, localized mid-cap index.
Just change the rules.
Right. And suddenly, their quarterly reports to the client look amazing. Look, we're outperforming the benchmark.
But they only outperform because they lowered the bar.
Precisely. The regulator steps in and says, no, if you change the measuring stick or you change the fundamental strategy we agreed upon in the IPS, you have breached the original thesis.
So the client can just leave.
The client has the absolute right to take their money and walk away, completely penalty-free. It enforces absolute transparency and accountability.
Okay, so the rules of the game are set. We know our weight class. We know the opponent we have to beat. When you actually beat that benchmark, that excess return is what industry folks call alpha, right?
That is correct. Alpha is the value the active manager actually adds above and beyond what you would get by just passively tracking the benchmark.
So how do we actually get that alpha? How do we divide up the money to start fighting the fight?
Now we enter the core engine of the entire portfolio management process, asset allocation.
The big one.
The NISM text states this unequivocally. Professional investment experience and decades of academic research prove that in the long run, the performance of an investment portfolio depends majorly on asset allocation.
So it's not just about picking the next Apple or Amazon.
No, it is not about picking the one perfect stock. It is about how you divide the total pool of wealth into different major buckets, like equities, bonds, cash, real estate, or commodities.
I used to think of asset allocation like baking a pie. You want 60% apple, 40% cherry.
Sure, that's the standard visual.
But reading this text, it's really more like building a sports team with a strict salary cap.
Okay, I like where this is going.
You can't spend your entire budget buying 11-star strikers. Sure, you might score a lot of goals, but the first time the other team gets the ball, you have no defenders and no goalie, and you lose the game.
Exactly.
Equities are your strikers. They score the points and grow the wealth. Bonds are your defenders. They provide stability. Gold or cash might be your goalie, the absolute last line of defense in a crisis.
That is an excellent way to visualize it. You need players who perform different functions at different times. And the scientific mathematical basis for how a portfolio manager chooses these different assets relies heavily on a statistical concept called correlation.
The text explains that correlation measures the relationship between the price movements of two different asset classes on a strict scale from -1 to +1.
Right.
Let's break down the math of that because this is the actual secret sauce of diversification.
Okay, so a correlation coefficient of +1 means perfect positive correlation.
Which means
The two assets move in the exact same direction by proportionate amounts at the exact same time. If asset A goes up 10%, asset B goes up 10%.
and if asset A drops 20%,
Asset B drops 20%.
which means if I buy asset A and asset B thinking I am diversifying, I'm just lying to myself.
Yep, you are.
In my sports team analogy, it's like putting two strikers in the exact same position on the field. If one gets red carded, the other one gets red carded too. I haven't reduced my risk at all. I've just doubled down on it.
Exactly. Now, a correlation of 0 means there is absolutely no statistical relationship. Asset A's price movement tells you absolutely nothing about what asset B will do.
They're completely independent variables.
Right. But the holy grail of risk reduction for a portfolio manager is finding assets with a negative correlation, moving towards -1.
Perfect negative correlation means they move in opposite directions.
Yes. The text gives classic examples of this. Equities and government bonds often have a low or negative correlation.
Walk me through a real-world example of that.
During a severe economic panic, let's look at the onset of the pandemic in March 2020, or the 2008 financial crisis. The stock market crashes. Everyone is terrified.
Right, everyone's selling.
But where does all that terrified money go? It flees to the absolute safety of government bonds. The sudden massive demand for bonds drives the price of the bonds up.
So while my strikers are failing to score, my defenders are actually playing the best game of their lives.
Precisely. The text also highlights gold. Gold and equities typically show strong negative correlation during severe geopolitical or economic crises.
Because it's a tangible asset.
Right. By combining these different asset classes that don't move in lockstep, or ideally actively move in opposite directions, the portfolio manager stabilizes the overall return curve.
It smooths out the ride.
You drastically reduce the volatility, the wild stomach-churning swings of the total portfolio value.
That makes sense in theory. But what does this mean for the actual day-to-day strategy?
Well, there are different ways to handle it.
Do I just set my team roster, say, 60% strikers, 30% defenders, 10% goalie based on my IPS, and then go to sleep for 20 years? Or is the manager constantly trading players and changing the formation?
That question highlights the dividing line between the two primary approaches detailed in the source material: strategic asset allocation and tactical asset allocation.
Okay, FAA and TAA.
And they rely on completely different philosophies of how markets work.
Let's start with strategic asset allocation, or SAA. The text describes this as a long-term foundational approach. You define the asset mix based on the investor's risk tolerance and return expectations from the IPS, and you just lock it in.
Yes. SAA maintains a fixed predetermined proportion. Let's say your IPS dictates a 60-40 split between equity and debt.
Okay.
The SAA investor maintains that split and aggressively ignores short-term market noise. If the stock market drops 500 points tomorrow because of a bad inflation report, the SAA investor does not panic.
They don't do anything.
They do not sell their stocks to buy cash. They stick to the 60-40 target. It is a highly disciplined, mostly passive approach designed for long-term compounding wealth creation.
But wait, I have to push back on this.
All right.
If it's March 2020 and a global pandemic is literally shutting down the entire planet's economy, You're telling me SAA means I just sit there blindfolded and watch my portfolio burn. I'm supposed to say, well, the IPS says 60/40, so I'll just ride it out into the abyss.
Yeah.
How is that not financial negligence?
It feels like negligence emotionally, but mathematically it is often the safest play.
Really?
Yes, SAA assumes that you cannot predict the future. By the time you realize it's a catastrophic crash and you decide to sell your equities, the market has already dropped 30%.
So you're selling at a loss.
You are selling at the absolute bottom, locking in your permanent loss. And worse, to successfully maneuver around a crash, you have to be right twice.
Right, twice? What do you mean?
You have to know exactly when to sell before it drops, and you have to know exactly when to buy back in before it recovers.
Oh, and nobody knows that.
Nobody. By the time you feel safe enough to buy back into the market, you have already missed the massive 20% rebound rally that often follows a crash. SAA protects you from the arrogance of thinking you can time the market.
Okay, I see the logic. It enforces emotional discipline by pre-committing to a strategy when you are calm, so you don't make terrible decisions when you are terrified.
Exactly.
Now, contrast that with tactical asset allocation, or TAA.
TAA is much more aggressive. The text describes it as a dynamic strategy where portfolio managers actively and continuously adjust the asset class weights based on short-term market conditions, economic trends, or perceived mispricing.
So they are actively changing the formation on the field based on how the game is going.
Exactly. In TAA, the manager is constantly hunting for market inefficiencies.
Okay, give me an example.
Suppose their base strategic allocation is 60/40, but they analyze the macroeconomic beta and see a massive short-term opportunity in equities due to a temporary dislocation in the market. Maybe a massive overreaction to a minor geopolitical event.
So they buy the dip.
Right. They might tactically shift the portfolio away from the IPS baseline, moving to 75% equities and 25% debt for a 3-month window. They are actively trying to generate higher returns by timing these market shifts.
But the text is clear that this comes with a massive cost.
Huge costs.
TAA requires immense skill and constant monitoring of hundreds of economic indicators, and it inherently carries exponentially higher risk.
Very true.
If you tactically shift to 75% equities right before a recession actually hits, you destroy immense value.
You magnify your losses.
Not to mention the friction costs. Trading back and forth constantly generates huge transaction costs and triggers short-term capital gains taxes, which eat away at whatever alpha you manage to generate.
TAA is where an active portfolio manager tries to justify their high management fees. SAA is about structural long-term stability. TAA is about capitalizing on fleeting short-term opportunities.
Okay.
But the NISM text introduces a third concept that sits somewhere in the middle ground, and it is fundamentally rewiring modern investing.
You're talking about factor-based investing, sometimes referred to in the industry as smart beta.
Yes.
I love this section. Here's how I process this concept when reading the source. Instead of just looking at the market like a grocery store full of different foods, like I will buy a IT stock or I will buy a pharma stock, factor investing is like looking at the nutritional macros of the food.
Oh, that's interesting.
You aren't just buying a stock, you are buying the underlying protein or carbs inside the market that actually drive the physiological growth.
That is a phenomenal analogy. Factor-based investing is about isolating the fundamental DNA of returns.
The DNA.
The text defines it as selecting securities based on specific measurable attributes or factors that academic research has shown are expected to drive higher returns over long periods.
So it's not just buying the biggest companies.
No, it moves completely away from the traditional method of just buying the biggest companies based on their market capitalization. It seeks to identify and capture the underlying reasons a stock performs well.
The nutritional macros of the stock market. So what are these factors? The text breaks them down into two main categories: macroeconomic factors and style factors.
Let's start with macroeconomic factors. These are the big, systemic, external forces affecting all asset classes across the board.
Like what?
We are talking about broad inflation rates, national economic growth, or GDP, interest rate shifts by central banks, and global liquidity.
So big picture stuff.
Right. You can build portfolios tilted to perform well during high inflation regimes, for instance, But the real day-to-day engine of factor investing lies in the style factors.
Okay, let's talk about those.
These influence the behavior and returns of individual securities within an asset class. The NISM workbook lists 5 prominent academically vetted style factors.
Let's unpack the mechanics of each of them. The first is the value factor.
Value investing is the classic Warren Buffett approach.
Right.
It is about finding stocks that are priced significantly lower than their actual fundamental intrinsic value.
Finding a bargain.
Exactly. The manager screens the market looking for companies with a low price-to-earnings ratio or a low price-to-book ratio. The market is currently ignoring them or punishing them for short-term bad news, but the underlying business cash flows are solid.
So what's the expectation?
The expectation is that over time, the market will realize its mistake, recognize the true worth of the company, and the price will rise to meet its actual value. It is buying a structurally sound house in a temporarily unpopular neighborhood.
I like that. Then there is the momentum factor. This seems fundamentally opposed to value.
It relies on a completely different behavioral phenomenon.
Okay.
Momentum investing relies on the principle that securities with strong past performance tend to continue their upward trend in the short term. A body in motion stays in motion.
So it's buying what is already going up.
Right, betting that the herd mentality and FOMO fear of missing out of the broader market will push the price even higher before it eventually corrects.
So you're not looking at the cash flows.
You aren't looking at the underlying cash flows as much as you're looking at the velocity of the stock's price chart over the last 6 to 12 months.
Third is the size factor. The text notes that smaller companies, small-cap stocks, tend to deliver higher returns than massive large-cap stocks over long time horizons. Why is that?
It comes down to a risk premium and the law of large numbers.
Explain that.
Well, a company worth $50 million has a lot more room to double or triple its revenue than a behemoth company worth $2 trillion. It's easier to grow from small to medium than from massive to gargantuan.
Right, that makes mathematical sense.
However, small-cap stocks are much more vulnerable to economic downturns and have less liquidity, so investors demand a higher potential return to take on that extra risk.
Fourth is the quality factor. Now, how does a manager actually screen for quality? It sounds so subjective.
In factor investing, it is highly quantitative. They look for specific metrics.
Like what?
Exceptionally strong return on equity, highly stable and predictable year-over-year earnings growth, and crucially, very low debt-to-equity ratios.
Oh, so they want safe companies.
Yes. They are screening for highly resilient companies with massive competitive moats that can weather severe economic downturns much better than their highly leveraged, debt-burdened peers.
And finally, the low volatility factor. Identifying stocks with lower historical price fluctuations.
Right.
Defensive stocks, utility companies, consumer staples, things people buy regardless of the economy.
Exactly. Historically, these tend to provide significantly better risk-adjusted returns because they don't suffer the massive compounding drawdowns of high-beta tech stocks.
So an advanced portfolio manager doesn't just wake up and say, I'm buying stocks today. They might build a multi-factor strategy.
Yes, precisely. A manager might utilize quantitative models to combine the quality factor and the momentum factor.
Combine them? How?
They write an algorithm that screens thousands of stocks in the market to find the rare intersection. Companies that have rock-solid balance sheets and low debt, which is quality, but that are also currently experiencing a massive upward surge in their stock price, which is momentum.
That sounds like a cheat code.
They are mathematically optimizing returns while trying to tightly control the specific types of fundamental risk they take on.
But the text is very clear to point out some massive challenges with factor investing. It's not a magical cheat code for infinite money.
Far from it. The first major challenge detailed in the text is factor cyclicality.
Meaning, not all factors work at all times.
Exactly. Factors go through agonizingly long periods of underperformance. Look at the value factor. During the massive tech boom of the 2010s, value stocks severely underperformed growth and momentum stocks for nearly a decade.
A whole decade.
Yeah. If a portfolio manager was entirely invested in the value factor during that regime, they would have trailed their benchmark significantly year after year and likely been fired by their clients, even if the underlying academic theory was sound.
You have to have the conviction to survive the cyclical winters.
You really do.
And the second challenge mentioned in the text is overcrowding. How does a factor actually get overcrowded? It's not a physical room with a fire code limit.
It happens because of massive institutional money. If 10 massive global pension funds and hedge funds all look at the same academic research,
Right.
and they all identify the exact same low volatility anomaly in the market, they all start pouring billions of dollars into those specific low volatility stocks.
And by pouring billions into them, the massive wave of buying demand drives the price of those stocks through the roof.
Which means they are no longer cheap, safe, low volatility value plays.
They ruin the factor.
The very act of the crowd trying to exploit the factor anomaly actually destroys the anomaly. The factor becomes overcrowded, wildly expensive, and highly susceptible to a sudden violent crash when all those institutional funds try to sell and unwind their positions at the exact same time.
Wow. The market is incredibly efficient at pricing in known advantages.
It absolutely is.
That perfectly illustrates that there is no single magic formula in investing. The market always adapts, the factors rotate, the economic cycle shifts, the prices move, and suddenly that perfectly balanced 60-40 sports team we drafted in Step 4 is completely out of whack.
Which brings us to the final and perhaps most painful step of the portfolio management process for long-term survival.
So let's say you started the year strictly following your IPS with 60% in equities and 40% in bonds.
Okay.
Then we have a massive roaring bull market. Your tech stocks go up 40%, but your bonds just sit there earning a flat 4%. By the end of the year, because the stock slice of the pie grew so much faster, your portfolio is now sitting at 80% equities and 20% bonds.
And that introduces a critical systemic problem.
Right, because my risk changed.
Yes. If your initial psychological and mathematical assessment dictated that you only have the risk capacity for a 60-40 portfolio, and you are currently sitting at 80-20, you are now taking on vastly more risk than your financial guardrails allow.
Even though I'm making money.
Even though you are making money, your portfolio is dangerously overweight in highly volatile assets. If the market crashes tomorrow, your losses will be catastrophic compared to what your IPS prepared you for.
Which brings us to Section 6 of the NISM text, portfolio rebalancing.
Rebalancing is the necessary mechanical maintenance of adjusting the asset allocation back to the original desired risk-return profile after market fluctuations cause it to drift.
So, fixing the pie.
You have to restore the intended 60-40 mix.
Here is the problem with rebalancing, though. Human nature absolutely hates it.
Yeah.
It physically hurts to execute.
It goes against all our instincts.
Think about what you actually have to do to get your portfolio from 80-20 back to 60-40.
Yeah.
You have to log into your account, and you have to deliberately sell off a huge chunk of your equity portfolio. The very stocks that have been winning, the stocks that are making you rich, the stocks everyone on the news is screaming about.
Yeah.
And you have to take that cash and buy more bonds, the boring, stagnant asset class that has done nothing for you all year. You are literally selling your winners to buy your losers. It feels entirely backwards.
It is entirely counterintuitive to human emotion, which is exactly why individual retail investors almost never do it properly. But the text lists the profound mathematical benefits of enforcing this ruthless discipline.
What are the benefits?
Mathematically, systematic rebalancing forces you to execute the ultimate golden rule of investing. Buy low, sell high.
Oh, because the equities have gone up, they are relatively high, so you are forced to sell them and lock in those gains.
Exactly.
And the bonds are relatively low, so you are buying them at a better valuation. You are systematically harvesting your profits without ever having to guess or time when the market is at the absolute top.
It completely removes the emotion from profit-taking.
That is brilliant.
But the text doesn't paint it as a perfect panacea. It starkly covers the very real challenges and frictions of rebalancing.
Right, because it isn't free.
No. First, there is a massive tax drag.
Right. If you sell those winning equities to rebalance your portfolio, you are triggering capital gains taxes. Depending on whether you held those stocks for a short-term or long-term period, the government is going to step in and take a 15, 20, or even 30% slice of those profits.
Yes, and that tax drag can severely compound against your wealth over a 20-year horizon.
So every time you rebalance, you're bleeding a little bit.
And beyond taxes, there are structural transaction costs. You have to pay brokerage fees to sell the stocks and fees to buy the bonds. You deal with bid-ask spreads and market impact costs.
Okay.
If a manager rebalances too frequently, say, adjusting the portfolio every single week just to keep it at exactly 60.0%, the continuous friction of taxes and trading fees will completely devour all the mathematical benefits of the rebalancing itself.
So how does a manager decide when to actually pull the trigger?
The text outlines different methodologies. Some use a simple periodic or calendar-based approach.
Like what?
They rebalance every December 31st, regardless of what the market is doing. It's simple, but the flaw is that a massive market crash could happen in June, and you wouldn't react for 6 months.
That seems risky. What's the alternative?
The alternative is a percentage of portfolio or tolerance band approach.
Tolerance band. How does that work?
The manager sets a rule. We only rebalance if the asset allocation drifts by more than, say, 5% from the target. So if equities drift from 60% to 65.1%, that triggers an immediate rebalance.
Okay, so it's based on math, not the calendar.
Right. It requires constant daily monitoring of the portfolio, but it provides much tighter risk control while minimizing unnecessary trading friction when the market is just moving sideways.
And throughout all of this, we keep coming back to the biggest friction point of all, emotional bias.
Always.
The NISM text explicitly cites the phenomenon of investors hesitating to sell winning assets due to the fear of missing out on further gains. I think this points to something profound about the entire industry. We always assume we are paying a wealth manager to be a math genius who has a crystal ball that can see the future of the stock market.
But the underlying subtext of this entire chapter suggests otherwise. A truly great portfolio manager does not earn their fee simply by picking the right stocks or running complex multi-factor algorithms.
How do they earn it?
They earn their fee by being the unemotional enforcer. They are the objective, third-party disciplinarian who executes the rebalance when the investor is too terrified of a crash to buy or too euphoric during a massive bubble to sell.
They protect you from you. Okay, let's take a breath and recap the incredible journey this NISM chapter just took us on.
It's been a lot of ground.
We started by building the foundational blueprint, the investment policy statement, which forced us to confront the hard mathematical reality of risk capacity versus the soft, often misleading psychology of risk tolerance.
Right. We then mapped out the invisible boundaries, the constraints, from rigid legal restrictions on trusts to highly emotional, unique attachments to employer stock that shape the structure of the portfolio just as much as the pursuit of profit does.
We looked at the regulatory rules of the game, establishing capital market forecasts, and the strict APMI regulations that force managers to pick a weight class, select a benchmark, and stick to it without moving the goalposts, keeping the industry honest and transparent.
We explored the core engine of wealth generation, asset allocation. We discussed utilizing the mathematics of correlation to build a resilient sports team of assets that can withstand severe macroeconomic shocks. We contrasted the steadfast emotional discipline of strategic asset allocation with the dynamic, active, and risky maneuvering of tactical asset allocation.
We looked under the hood at factor-based investing, targeting specific DNA attributes like value, momentum, and quality to optimize returns, while acknowledging the severe dangers of factor cyclicality and institutional overcrowding.
And finally, we confronted the painful but mathematically vital discipline of portfolio rebalancing, forcing ourselves to sell our highest-flying winners and buy our stagnant losers, to systematically lock in gains and reset our risk exposure, regardless of how unnatural it feels.
This logical, deeply structured, heavily regulated approach is exactly what separates professional wealth management from amateur gambling. Thank you for joining us on this deep dive. We hope unpacking this NISM framework has given you a completely new perspective on the rigorous mechanics behind how professional wealth is actually managed. But before we go, I want to leave you with one final thought based on everything we've just uncovered.
We've spent this entire time talking about the complex mathematics, the stringent APMI regulations, and the sophisticated quantitative strategies used to navigate the financial markets. We've talked about correlation coefficients, factor models, and generating alpha. But considering how the very foundation of this entire process, the IPS, is built completely around human emotions, uniquely irrational constraints, and deeply ingrained behavioral biases, is the ultimate purpose of the portfolio management process, not to manage the market, but actually